Thank you everyone for coming. My name is Kate Hansen and I'm with the Center for Rural Affairs. I'm joined by Joe Toillion and we're here to discuss Crop Insurance 101 today, kind of a big picture view of crop insurance. And I'm curious, can everybody see my slides? Does that look okay? Awesome. Like I said, I'm Kate Hansen. I am based in the Center for Rural Affairs, Nevada, Iowa office, and I'm a policy associate. And one of the topics I work on is crop insurance, working with a lot of farmers and some ranchers on their options. And I'm joined today by Joe Toillion, who is an agent in Iowa who sells crop insurance. Agent. Joe, would you like to introduce yourself?
Yeah, hello everyone. My name is Joe Toillion. I live in Jewell, Iowa. Sell crop insurance in a couple states, and I'm glad to be here.
I'm glad you're here too, Joe. For those on the call, Joe has experience with conventional, organic, and livestock policies and has some unique experience as well. And so I'm really excited he's here to join us and we'll be able to answer some questions at the end. So just a bit about the Center for Rural Affairs. We are a nonprofit that for nearly 50 years has stood up for small family farmers, ranchers, new business owners, and rural communities. And we care a lot about the present and future of rural communities and ensuring that our communities are vibrant. We have staff in 4 states. We are largely based in Nebraska, and that's where most of our staff is. That's where we were founded. Our office there is in Lyons, Nebraska. We also have 4 staff in Nevada, Iowa, which is where I'm located, 1 staff member in Minnesota, and 1 in South Dakota. And sort of the reason we have an interest in crop insurance and why we're excited to talk about it today is that we see it as a tool in a producer's toolbox to manage their risk. So for some, that is sort of the tool, and that's the most important tool that you fall back on if you have a loss. For others, it may be a smaller tool or maybe not even purchased at all if that's their choice or they have other considerations and it's not needed. But what's important to us is that if you do want to think about crop insurance, that you have the information you need and that you have the materials and all of the information to make the best decision for your operation. But just a few reasons why someone might buy crop insurance. Risk management, of course, protecting your revenue, protecting your dollars. Some programs and loans require you to have crop insurance to be eligible. And also just summed up by this quote by a Minnesota farmer that we work with who says he buys crop insurance to sleep at night. So today our plan is to discuss multi-peril crop insurance, which is sort of the main crop insurance that a lot of farmers may be purchasing. Then we'll talk about some specific options available for certified organic crops. And we'll talk about what you do if you don't have that multi-peril crop insurance available to you in your county, and we'll discuss why that might be as well. Talk a little bit about livestock coverage. Joe has a lot of experience with livestock risk protection, so we'll focus on that program. And then we'll talk about finding an agent and have some time for questions. And I want to emphasize this presentation will focus mostly on federal crop insurance. When you work with an agent, there are some private policies or private products that they can offer you, but usually they are sort of supplemental to something like multi-peril crop insurance. So this will be focused on those federal programs administered by an agency at USDA today. And as we begin, I'd like to just poll all of you on the Zoom. So my colleague Teresa is going to get a poll up on the screen here. And the first question will be just where are you at with crop insurance on a scale of 1 to 5? How are you feeling about it at the beginning of this presentation? 1 is no understanding, 5 is you could be given this presentation yourself. All right. So I think we got probably most folks that are going to do it. And our next question from Teresa is going to be related to your profession. So are you a farmer? Are you a landowner? Are you, a nonprofit professional? That's going to be our second question. Awesome. Thank you all for doing that. Looks like on my end that we have a good mix of farmers and landowners and even a few crop insurance agents. So if you need to chime in, put something in the chat. We probably could have some help if we need it today. So we'll start here. Like I said, multi-peril crop insurance. This is likely what most farmers are using. There are different types, and we'll get into that in a second. But generally, this is protection against natural perils, and in some cases, revenue loss due to price changes. Coverage is available from 50 to 85% in 5% intervals, meaning 50, 55, 60%. And it's subsidized and administered by the USDA Risk Management Agency, or RMA, as we might refer to it in the presentation. And those subsidies do vary by level of coverage. So if you are purchasing a lower level of coverage in the 50, 60 range, you're going to have a higher subsidy and vice versa. And what that means is that getting up to that 85% is ultimately more expensive on the producer's premium they're paying. And these policies are available by crop and by county, which is going to be really important later when we discuss availability.
Okay. I guess I'm up, right, Kate?
Yes, if you'd like to take it.
So multi-peril crop insurance, MPCI, as we'll refer to it moving forward here. There's straight yield or APH policies, and then there's revenue protection policies. The yield or APH policies protect you against production losses, and they do not have the fall harvest price option. And revenue policies protects you against perils and price drop. An example of an APH policy would be in the state of Iowa, as an example, oats are only, you can only insure oats under an APH policy. They don't have the revenue loss with the spring and fall harvest price option. On revenue policies, you can choose not to take the fall harvest price option, but that would not make a lot of sense. Some people do it to save a little bit of money, but that's their prerogative. APH, which is actual production history, is a word that's thrown around a lot in crop insurance. It's the average of past yields, previous years, minimum of 4 years, maximum of 10. So if you have no APH or you don't have 4 full years of production, a producer can use transitional yield or what we call county T yield. So for an example, if you were a new producer, you would have 4 years of the county T yield in your production history. If you had 2 years of your own production, you would have 2 years of the county T yields, and so on until you get 4 of your own yields, 4 years of your own production.
And that APH is really important when you start calculating things like your guarantee or your coverage per acre. And ultimately, if you have a claim, if you have a loss and do need to file a claim on your insurance. So Joe and I are just going to run through a couple of examples of how these numbers all get plugged in. Using these numbers, these aren't sort of specific year prices or anything like that. These are just similar and easy numbers to do some examples with. And this would be around the range of corn in Iowa. So we've got a spring price of $4, a fall price of $3.50, APH, or that yield history, of about 200 bushels per acre. They've opted for 85% coverage, and then they harvest a little bit less than their average, or considerably less than their average, 150 bushels per acre. So the top line here is how coverage is calculated, how your guarantee is calculated. The final number comes in units of dollars per acre. And so you multiply the spring starting price by your yield history, or APH, by your coverage level, that percentage, and that's your guarantee per acre. So for that example, we'd have $4 times the APH times the 85%, and this person would be covered for $680 per acre. And so for that same person, that's their coverage. Let's say they file a claim because in this case, there was a price drop and they didn't harvest as much as they probably were planning. So to calculate your claim, you take that guarantee number, which we said was 680, and you subtract what you harvested times the fall price. and that's your claim. And so once again, with that example, that'd be 150 bushels per acre that they harvested times the 350, 525 an acre. And then we subtract that from 680, which was their guarantee. And they're looking at about $155 per acre. Another important part of this is how many acres are we talking? And that gets to this question of unit structure. And I think, Joe, if you want to explain this one.
Sure. Yeah, I'd love to. So I meant to explain how the spring price and the fall price are calculated. I'll do that real quick. So your spring price is established during the month of February. They're going to average, we'll just use corn and soybeans. They take the board settled price for the day for corn and soybeans. They use November beans, December corn. And so they average that for the month of February. That's your spring starting price. For your fall harvest price, they do the same calculations in the month of October, December corn, November beans, daily average. So that's how they calculate those before we move on to this. So that's that. MPCI unit structures, we'll use the two extremes, such as optional units and enterprise units. Optional units are calculated based on per land unit down to the section level. Individual coverage on land units all the way down per section. The premiums are higher, claims are evaluated different. Enterprise units are combining everything by county by crop. So they would take all of your fields and by county by crop, and they would make just a big average of all of that. And when you turn claims in, they will use basically the county as one field for you for whatever crop you have. So for example, enterprise units are popular because there's a great savings on enterprise units. It's a lot cheaper. But if you would have a loss, and let's just say you have multiple fields in a county, and some of them were affected by some peril. Let's just say last year the derecho storm came through your county. The southern half was hit, the northern half was fine. Those fields that were damaged severely by the derecho storm, their losses would be offset somewhat by the really good yields that were, not in the storm's path that benefited from the rain that it brought. So for example, that's an example of those two things. Producers love enterprise units when they get their premium bill. They're not crazy about it if they have a lot of losses. So that's, in a nutshell, those are those two things, or those are the two extremes. There's other options, but those are the two extremes. So that is that. MPCI, Multi-Peril Crop Insurance timeline. March 15th is the spring sales closing date, which means if you're a producer, you have to have an autograph on a signature on a policy with your choices for this year by March 15th. And you can, the sales period is March 1st to the 15th, okay? July 15th is acreage reporting date. You have to be in the FSA office and certified prior to that. Agents, we have some days after that for keying, but the documents have to have a timely signature of March 15th for your sales closing date and July 15th for your acreage reporting date. Late planting dates are May 31st for corn, June 15th for soybeans. And if you would plant after those dates, you lose 1% of coverage per day of your dollars of coverage. So that's how that works. Premiums are due in September, and claims process is always in the fall. We can turn claims into December. So that is that. What else we got here? Okay.
And I can take this one, Joe. We were going to transition into what to do if you're certified organic and what are the unique options available to organic crops within the MPCI system or within MPCI policies. And there are kind of two main ones. The first is what's called organic price elections. And in its most basic form, when we were doing all that math and we were plugging in prices, this says RMA has set an organic price for organic corn or organic soybeans or whatever it may be. And that price is then factored into all of your coverage and claims and all of that. And what it means is you're actually covering the value that an organic farmer has out there in the field. 10 years ago, this was not an option, and an organic grain farmer, for example, would be using conventional prices, and that was sort of the best that they could cover themselves with. And this is a more recent development that's really great to see. It's available for 80 certified, or more than 80 certified organic crops nationwide. But once again, it does depend on where you're at, your state and your county in the crop. There's also what's called the contract price option. And in this option, essentially, if you have contracts set, then your crop for those that's in those contracts can be insured at the contract price. There is an upper limit on that. It's up to 150% of the spring starting price. But what this means, once again, is you can better cover the value that you have out there in the field using the contracts. And this is available for both certified organic crops and crops in transition, which Joe will talk about in a little bit, but that's a really unique option for transition years. And the important thing to know is you should sign up, or can sign up for this, by the sales closing date in the spring, March 15th. But that doesn't mean you have to have contracts in hand. Just by March 15th, you basically have to say, I want to keep this store open. I want this to be an option for myself. And then you would be required to show your agent your contracts around the acreage reporting deadline, which is a few months later. So just by that March deadline, it's just saying if you'd like to keep the door open for yourself. And because you are covering more value, you will see an uptick in your premium price. But a lot of agents I've spoken with, including Joe, I think would say that is worth it in many cases for the increased coverage that you're getting with this option. So Joe, do you want to show us a few examples of how these pricing things kind of work out in real life?
Sure, you bet. We'll use an example in Hamilton County where I live. This is a quick quote bid from this spring. I'm going to increase this in size because I can't see that small. Okay, so we're looking at Hamilton County. We'll use the example of organic corn. We have a 70% coverage level and 85% coverage level. We're also going to look at the optional unit structure pricing and enterprise unit structure pricing for organic corn. So here we have, and we're using the county T yield for our yield in this example. Okay, so if we look at the first example, 75% level of coverage for organic certified non-irrigated grain, which this is corn, in Iowa, Hamilton County, this is optional units. So our starting price is $9.56. That was the spring price for organic corn. The T yield for the county is 126 bushels. This is an example of 1 acre. So your dollars of coverage per acre is $843.19. That's your total coverage. If you slide over, the premium per acre total for the producer premium is $11.34. And the subsidized portion is $16.31. So the total would be those two added together. The producer's portion is $11.34. Drop down one line, we've got the 85% level of coverage with the same factors in here. We've got a 956 spring starting price, 126 bushels for our T yield for the county. And so the coverage price, because it's 85% coverage, your level of coverage goes up to $1,023.88 per acre. That's your guarantee, dollar guarantee against revenue drop and perils. So if you slide over to the producer premium in this example is $46.99. There's $28.80 that's subsidized. So those two things added together would be the total premium. Producer's premium is $46.99, so $47 roughly. And so that is substantially higher, but the dollars of coverage also is substantially higher. Now, if we look down below at the enterprise unit option for those same factors, we have, let's see, we have the same spring starting price, the same yield, the same dollars of coverage per acre. But the producer premium in this example at 70% coverage is $4.01 per acre. Okay, with optional units, it was $11.34. Okay, that's substantial. Okay, and for the same dollars of coverage. If you look at the 85% coverage level, Same numbers, same spring starting price, same yield, same all of that, same $1,023.88 of coverage per acre, but the premium here is $28.70 instead of $47. So that is substantial. I mean, that's a big savings. So if it was a producer that had fields that were in a relatively close proximity that were probably going to get affected by the same perils in the same area, this is enterprise units are a no-brainer. If you have different soil types and fields scattered throughout a county, there's a lot of dollars involved in organic production. They're very limited to what they can do with, they can't spray anything. They can't use commercial fertilizers. They can't use fungicides. They can't use any of those things, no herbicides, any of that. So their hands are tied. They're really at the mercy of the environment. So, enterprise units, in that example, if you have substantial acres with distance between them that can be affected by perils, by weather, by just soil types, that extra money per acre on optional units is, in my opinion, is definitely the way to go. When you have claims, you will thank me for that. Okie doke. Let's go to the next one. So this is an example of that contract price option that we mentioned. So in this example, this is Hamilton County. We're just looking at the 85% level of coverage. But in this example, 85% coverage, if you could go to a processor and get a contract for an organic premium, non-GMO, some type of factor like that, you can use up to 150% of that $9.56 spring starting price. So in this example, we've done that. So you have a spring starting price of $14.34. Okay. You have the same 126 APH bushels per acre, 1 acre. And if you look at the difference in coverage, we were at $1,023.88. This example is $1,535.81. So, it's $500 of coverage more per acre. And that's substantial, especially in organics. They're affected by perils way more than commercial and conventional. So, So anyway, your premium is $70. The producer's portion is $70.48. But the more coverage that you have picked up is very substantial, and most people, if they can get that, this year was tough to get contracts from processors. Didn't see a lot of them. Some bean contracts were out there, and guys took advantage of that, and they picked up $5 or $6 extra per bushel than the spring bean price. But corn wasn't impacted by that. So so that's that. So that costs a lot more, but at the same time, it definitely is worth it. So just from a dollars of coverage per acre standpoint. So let's look at covering organic value. And so this is how transition years work. And so to be an organic producer, it takes 3 years to transition to certified organic. So your crops are raised under organic practices, and under crop insurance, they're protected at conventional prices. So, producers want to transition as profitably as possible. So they look at doing things like raising hay. They may raise blue corn for a tortilla chip market. They may do some of those things. But one thing that they made some changes in the last few years is you can also use contract price option for transition. If you can get a non-GMO contract, a tofu bean contract or something like that, that kind of thing. If you can pick up a contract from a processor, you can use up to 150% of the conventional price, not the organic price, the conventional price. So if it's a $4 guarantee on corn, you could use up to $6, for example, and that's significant. That'll bring your protection of coverage higher by using that. And once again, this year was a little tough to find those things, but in years that are more, there's no such thing as normal anymore, but years that are more common from past years, those were available. And so anyway, that is that. You can't go over 150% of the conventional price like we talked about. Okay, so and then your policies, Kate's going to talk about some things here in a minute, but policy availability is dependent on crop and county. So with that, I'll turn it over to you, Kate.
Thanks, Joe. Yeah, we have alluded to this a few times, and I think with some visuals, this will make a little more sense. There are details that we're going to try to avoid just to give you the big picture here, but essentially where you're at and what you're growing depends or determines what multi-peril crop insurance you have access to. So for something like corn, there's pretty widespread availability. This is a map I just kind of took a screen grab from the RMA website of corn in the US, and all of the counties that are that sort of teal color are where corn policies are available. So as you can see, as I said, pretty widespread for something like corn. And comparing it to oats, a small grain, we see a little bit less coverage, but still pretty widespread. And then if we get into something like popcorn, we're kind of concentrated in the Midwest, Great Plains, and something like rye, it's even more limited. And so if you're in any of those white colored counties, you don't have a sort of off the shelf rye policy, generally speaking, that you can just go in, sign up and buy it. So the question then is, what do you do if you want to grow rye in a county it's not available? Or what do you do if coverage isn't available for you? And there are two sort of options that we'll discuss today, worth trying, very different in nature. So the first is insuring by a written agreement. Written agreements, there are lots of different types, and we're going to resist kind of getting in the weeds too much on this. But basically, a producer can apply for individual coverage if their crop isn't insurable, or if they don't meet production criteria based on their land type. And so you would apply alongside your crop insurance agent for this, give them a lot of time in advance, about as much as you have, just because it is a process that you'll be going through. And that application will require supporting documents. So oftentimes they'll ask for details of a similar coverage in another county where it is available, and kind of using that to base your coverage off of. They may ask for letters of support from an agronomist or an ag organization, and also some details on your production history. So it is an application process that you'll do with your agent. Another option is what's called whole farm revenue protection. This is a newer product that RMA offers as part of federal crop insurance. It's actually a pilot program at this point. And it's unique in that it ensures your revenue history based on your tax documents, your Schedule Fs, and not based on your yields or your APH or things like that. It's very unique in its structure. It also means that the timeline is unique. If you have a claim, your timeline is going to be further into that next year because you have to wait for tax season to come around. So it is different than the MPCI we've been talking about. And this is certainly something you should discuss with your agent if it's the right fit for you. For some it is, and for some it isn't. And this really should be a good, dialogue with you and your crop insurance agent. And now we'll talk a bit about livestock coverage.
You don't want to cover livestock coverage?
No, I told Joe that I'll let him have the slide.
I'll do it. I promise. I'll do it. So livestock coverage has been around in crop insurance for a number of years. I've been involved in it for a long time, many years. So there are a few policies that you can choose from. I'll go over a couple of them here, then I'll kind of zoom in on the one that I'm focused on mostly. So right now you can purchase livestock risk protection, which protects against falling prices. You can use livestock gross margin, LGM, and that protects you against revenue loss based off of cost inputs and production costs. And then there are several dairy products. One is just a milk price drop program, and another one is like LGM dairy, which goes off of just input costs and feed costs and labor and things like that. Okay. So LRP, livestock risk protection, is one I've been involved with for a long time and really enjoy it. I've got I'm a farm boy. I got a background in livestock, worked in the animal feed industry for a long time before I got into crop insurance a while back. And so anyway, LRP is livestock risk protection. It protects them against price reduction for fed cattle, feeder cattle, and swine. They made changes this year, so it's the same program with better. It's more affordable. They increased the subsidy, and also they changed the payment terms from previously it was due when you sign up for a policy, and every time you put some cattle or hogs on it, it's called an endorsement. So every endorsement in the past, if I would write an endorsement for you, if you would look at the, you picked a endorsement you wanted to purchase, I would write it for you, and within a few days I would have to come and not only get your signature on the documents, but also get a check from you to cover the premium. So it was due up front. Now you pay at the end. In fact, it's a month after your end date. So let's just say your end date's December 15th. You're going to get a bill in January for that endorsement for the cost of that policy. So that is, that's a big deal. So the way the coverage prices are established, your floor prices are based off the Chicago Board of Trade. You have 13 weeks is the shortest one you can do, out to 52 weeks. And they offer those in about 4-week increments. So there's just a list every day of what they offer. Sometimes they offer pages of it. Sometimes they don't offer very much. It's based off of trade volume on the board, which month they offer. But typically this year has been, it's been a great year to cover your livestock, just because the prices are substantially high, much higher than we've had in the past. But and there's a lot of volume on the board. So they offered, a lot of opportunities to purchase this for different months, whether it's short-term 13-week or all the way out to 52. So coverage level available for this, it'll cover between 70 and 100% of that price off the board. So this is one of the few products.
Nelson, I was trying to track down Raymond Yoder. Is he available?
So this is one of the few policies you can buy in crop insurance that could cover you up to 100% of your price. So anyway, that is that. If anyone has any questions on that, if you're a swine or a beef producer, we can have my contact information in here somewhere, and I can answer some more questions about it. But it's a really good program. Basically gives you a floor price. The way it works, you have an end date, you have a start date, which is when you purchase your endorsement. You have an end date when it's finished. And then they do the math at the end. If you have money coming back, that's when they write you a check. So if the price drops, you're guaranteed at that price level. But if the price goes up, you get all the up in the market. Okay, so you be out your premium. But if the market shoots up $10 a hundredweight, you get all of that. There's no penalty for prices going up. So it works very, very well. Anyway, with that, I'll turn it back over to Kate.
Yes, and I think we had one last topic of our presentation we wanted to discuss, which is really the importance of finding an agent. We're leaving it to the end of this presentation, but it really is sort of the first step of getting into any of this, is finding a good agent. As I said, have worked with a lot of farmers and ranchers who use federal crop insurance, and can tell you that those with a good agent, a good relationship with their agent, frankly, it just works a lot better for them, and it's really valuable to have that person there. My best advice is really to ask around to fellow farmers, producers, who they use, if they like who they're buying crop insurance from, especially if you have a specialty, like if you're organic or if you're growing a particular crop, finding someone who knows something about that type of policy is really critical. There is also what's called the agent locator tool. It's something on RMA's website. And if you go in and Google RMA agent locator tool, it should come right up. But this is something online where you can check boxes based on your location and I think crop and distance and things like that. And it will show people in your area selling crop insurance as well. But as I said, my first recommendation is really to talk with fellow producers. I know in talking with Joe that's how he gets a lot of his business, and it's just really critical. Another thing that not everybody knows is that you do not have to be just down the road or sort of nearby your crop insurance agent. The main thing that is required is that they are licensed to sell crop insurance in your state. So Joe is selling Iowa, Minnesota, and Missouri, if I got that right. So there are certainly crop insurance agents licensed in multiple states. And if that person works better for you, or knows about a policy you're interested in, really consider having a distant relationship with them, and most of it can be done over the phone, certainly. So that's really important to this whole process, as well as that partnership. And I think that's where we end our presentation. And we wanted to give ample time for questions. It looks like we have about 20 minutes if we want to use all of that. And I see some already in the chat. Joe, are you good to just kind of start jumping into some of these questions here?
Yeah, if I can figure out how to see those.
I can read the first one. It's
I just want to take down the presentation. I can probably see it then. Or just read it. I don't care. That's fine.
I'll read this one and then I'll figure out how to do that in the meantime. This one's from Cassidy. It says, how is availability of policies determined? Is there a process to encourage expansion of crops or counties?
Sure, yeah. So organizations like Center for Rural Affairs is a good place to voice your concerns. They work with RMA at some levels. RMA is doing a pretty good job of expanding a lot of things, and these last few years, especially on the organic side, they have offered substantial expansion of crops, and commercial too. I mean, in Iowa, for example, there you can insure apples, you can insure alfalfa hay, lots of different things that we never could before, and popcorn, and some counties have wheat. So if you're close to a county that has wheat coverage, when Kate was talking about a written agreement, those are opportunities where you can go to RMA and have request a written agreement with them for covering your wheat in your county, that kind of thing. So yeah, just be vocal, be patient. We went from not having anything probably 5-6 years ago on the organic side, conventional prices, no contract price options, all those things too. They have really improved it substantially in the last 5 years. And the last couple of years they've really increased things. So they have their ear open to producers and that type of thing.
Yeah, and I would just add, of course, it's related to, locally what's being produced already and what numbers RMA and FSA and those involved can get their hands on to establish things like T yields. And I have not heard this from RMA or USDA, but kind of in other conversations that requesting by written agreement, if they start to see lots of requests for rye in your county, that might raise some flags or kind of create that conversation. So I've not heard that from RMA directly, but that could be an avenue too, at least to formally document that, hey, I'm someone in this county that is interested.
Yep. So back to the written agreement topic, keeping your own production records, even if you don't have it covered by crop insurance, if you're raising some of those products, if you're raising, buckwheat, spelt, if you're raising, the things we've talked about, wheat, and if you have production records on those, that's another thing that you can do to maybe have some ammunition for a written agreement, and that's important. That's probably more important than the other. If you have actually proven production records, if they can say, hey, I've been raising rye in this county for 10 years and these are my yields, they're going to have a lot more. They're going to listen to you probably louder at that than the other stuff, but they will listen to all the other things too. Anyway.
All right, we have a question from Facebook. So someone watching on Facebook asks, does livestock risk protection work for small scale producers who sell locally? What about product liability when custom slaughter is involved?
Okay, so originally it was designed for small independent producers. They've expanded the numbers you can put on it, so it's drawn some of the bigger feed yards and whatnot. But so it doesn't have like if you're going to do a hedge on the board and you would need to have 40,000 pounds on a contract, LRP isn't like that. You can do as few as one head, okay? So the way they do the calculations, the end value calculations, has absolutely nothing to do with what you receive for your cattle, okay? So how they calculate that, for example, is the starting price is based off the Board of Trade. So you got a floor price. They do the same thing for fat cattle and feeder cattle. The end price calculation for fat cattle, they take the USDA 5 area national slaughter price. So whatever the average for slaughtered cattle on that given day is, those are the factors that they use to go against your guarantee. So if nationally cattle have dropped, that's how you get paid. For feeder cattle, they use the national, well, it's just called the Feeder Cattle Cash Index, which is there's several video auctions, sale barns, brokerage places that buy and sell feeder cattle that tell the feds every day how many head they bought, what they weighed, what they paid for them. So those are the factors they use to calculate whether you have money coming back, which is good because if you have a local market and you get a premium on top of that, the way LRP works, it doesn't take any of that into consideration. So you get all the up in the market and the premiums you would receive, but you could still collect on LRP if the markets drop nationally. So I think I answered that well enough. I don't know.
No, that made sense to me at least. And I'm very grateful you're here, Joe, for answering those livestock questions.
So hogs, for example, if you're raising hogs, they do it similarly. So they establish your floor price off the board, and then your end price value is the USDA 201 sheet, which is every day, every processor has to, the big processors, they have to tell the government how many head they bought, what they weighed, what they paid for them. They have a formula price and a negotiated price. Negotiated price is just the open market. The formula price is all these formulas that are out there. And that's what they use. They average those two things, a weighted average of those two things, and they subtract that from your guarantee. So let's just say you're raising Berkshire or Duroc hogs, and you're getting a big premium because of the value of that product. You would get to keep all of that. You wouldn't be penalized, but you could still collect on LRP if the price of hogs fell, on the national level or commercial.
All right, pivoting just a little here, someone had a question about pasture, rangeland, and forage. So they say, or Pete says, can you speak to insurance options for forage? My understanding is that the pasture, rangeland, and forage program is available in some areas, but is limited.
So it's available. The sign up is in, I think it's in November. So the pasture, forage, and rangeland, that policy, it just goes off of rainfall and the rainfall index compared. So you get paid based off not how much hay you make or what your pastures look like to graze on, but how much rain fell at certain times of the year. And you pick a certain time of the year you want covered and those types of things. It's available. But I've sold some of it. I haven't sold any for quite a while. Right now we're actually getting some alfalfa or just some hay policies in some counties that are available where you'll get paid for your production. You're insured against your production, and those things are pretty valuable. But the rangeland programs are good too. The headache with those is they're right in the middle of harvest in the fall. The sign up period is for the next year. So you kind of got to have that in mind, going into harvest, and talk to your agent about that before because if you called me up in March and say, hey, I want to buy that, I'd say, okay, well, we can sign you up this fall, but it's for next year. So it doesn't do you much good for this year. But that's how those have worked in the past.
All right. And Pete also asked, does grazing cover crops pose any risks for crop insurance eligibility or coverage?
Okay, so it's twofold. The termination date for cover crops in the spring, as of this year, you could still graze it. So you could plant something in the fall, it'd pop up, it'd go dormant, it'd come up in the spring, and you're going to have to do something to destroy it. Grazing doesn't destroy it, but you can graze it up to the termination dates that they establish. And county by county is different. There's this crazy map that cuts kind of northwest to southeast through the state, and it zigs and zags. But in some parts of those, in some areas of those, it's established a certain date that's got to be terminated. The other side is within so many dates of planting, or it's a little confusing. But no, you can you can't hay it and sell it, but you could hay it, you could graze it and use it for your own cattle, or horses or sheep or whatever you're feeding it to, and you'll be fine long as you work along with the dates. The fall harvest grazing dates, you have to look what those are. You can, for example, you chop silage and then you seed it down with a cover crop, and after a certain date, you can actually graze that in the fall too. So, and then there's always the weather implications. If we get a drought, they open all that stuff up, and there's just no rules anymore. So pay attention to what's going on, and so the cover crop, the cover crops, what they let us do with them now, everywhere from for organic guys, from different ways you can terminate it to what you can do with it. It's pretty valuable.
I don't see any more questions in the chat, so please keep them coming if you have them. But if folks do, I thought maybe, Joe, we could briefly talk about the difference between private and federal policies and kind of the distinction there. In a basic sense, my understanding is these are products made available by the agents, so sort of their own company, not related to the federal stuff with RMA.
Mm-hmm.
And sometimes they're supplementing MPCI. So if you're in Kansas and you have fire concerns, you might buy fire protection. Or if you're in a hail alley or something, you might be looking at hail coverage. But how in your mind do you think about those two things?
So the private products, the AIPs, the approved insurance providers, or the companies like, Agrisampo, which used to be Armtech, Rain and Hail, NAU, those companies, they all have private products. So they have, hail is probably the most popular one out there. You can buy supplemental hail that is just in addition, has nothing to do with your federal crop, but it's in addition to that. Wind insurance, fire insurance, those type of things, those are very popular. The ones that are the private products that are new within the last few years are some of them that can give you some extended coverage on production or price. Some of them are actually they will give you they claim that it gives you a higher spring starting price, so a higher guarantee, but it's separate from multi-peril crop insurance. So they're two separate things. They're calculated completely different. Those things I have a problem with. I mean, those things pay me really well, but they may not do you much as a producer. They may not, do a lot for you. So I look at those things every year, kind of year by year, look at those and evaluate them, value that they have for producers. But there's a lot of them out there. Some of them are really confusing. Some are pretty simple, but the most popular ones for private products would be just hail and wind and things like that. So hail and wind and fire are covered in federal crop insurance. So what you're doing, you're buying more of what you already have. So it's supplemental. Other than fire, if fire insurance, as an example, the reason guys buy fire insurance is if it's not a natural fire, strike a lightning or something like that, it's not covered. For example, if your neighbor's combine starts on fire from a bad wheel bearing or something, and it gets into your field and burns up your corn crop, that is not covered under multi-peril crop insurance.
We do have one other question from Randy, actually related to those sort of natural perils. As guessing you see an uptick in policies following a natural disaster, I guess kind of as a question, do you see that? And then what about forecasts from the Farmer's Almanac? Do people purchase policies based on those type of predictions?
Not in my world too much. Basically, very few people don't have federal crop insurance. Some do, but basically, most people are on federal crop insurance for just like the one farmer said at the beginning slide, I buy it so I can sleep at night. You can't adjust from, just emotions from year to year. I don't see a lot of people jumping in and out. The thing that varies with crop insurance the most is levels of coverage. And, so for example, this past year, we had corn. The corn price the spring price on corn had been, $4 or less for 5 or 6 years in a row. It really didn't move down, up or down very much. Okay. Well, this past year, it jumped up substantially. Corn and beans are a lot higher than they were a year ago. So when we did quotes, premiums are a lot higher, and guys have been buying in crop insurance for, 18 to $22 an acre for 5 or 6 years. And all of a sudden it's 34, 35, 36, depending on your county. And there's some sticker shock. So some guys went from 85 down to 80%. And, it looks like we're going to get a crop. A month ago when we were thinking we're going to have drought, they were wishing they wouldn't have done that. But yeah, that's cost of premium and values probably dictate more variance in coverage levels than anything else. But as a rule, guys buy crop insurance, they're gonna buy it year to year, and that's just how it is. So it's part of they just plug it in as part of the expenses of their operation. So.
Any other questions or anything you want to mention before we go, Joe?
No, I appreciate the opportunity to be here, and yeah, I'm glad our drought looks like it's subsided. We didn't get rain for about 4 weeks here, a pretty critical time, and it looks like things have changed substantially. So yeah, no, it's no, we're good. Producers out there, be safe this fall.
I think we have one more question, and then maybe we'll end with this. And before everyone logs off, we do want to ask that you would do one more survey, like what we did at the beginning. How are you feeling on that scale of 1 to 5 on your knowledge? Just to kind of let us know how we did, and if you'd indulge us in that survey right before we go. But the last question, Cassidy says, does it make more sense to get a written agreement or just go the route of NAP for crops not covered by MPCI?
So, yeah, if you can get a written agreement, you are in with crop insurance like it's covered in that county. So I think your cost of coverage is going to be less. I think the terms are going to be more flexible, and some of those things. But you can always do both. You can apply for the written agreement and see if you get it. You don't want to wait till spring to apply for a written agreement. You want to do that kind of in the off season in the winter and kind of get that process rolling. So if there's any back and forth or any questions, you have time to do that. But I would start with a written agreement, and if it doesn't work out for you, you can roll into the other.
Awesome.
Written agreements can be complicated, but I mean, all those things that aren't the norm, they are. So it's just time, and just have to get after stuff early, because there's deadlines. You have to be ahead of those.
Certainly. And I'll say too, if folks have questions that dawn on them right after we log off, feel free to email either one of us. I'm Kate H, Kateh at cfra.org. And Joe is joet45@gmail.com. So if you do have questions, let us know. And if you wouldn't mind just doing this survey right at the end, I think my colleague's gonna get it up on the screen, and just let us know how we did and if you feel any different about your knowledge at this point. But while you're doing that, thanks again. And thanks, Joe, for joining us and giving us your on the ground expertise. It was really great to have you.
It's a pleasure. Thank you.
Awesome. Thanks everyone so much.